Are we headed to recession? What does that mean? How are these interest rates impacting the world and the economy? And what is the Fed going to do going forward? How do we make our positions as investors with that information? This is the Invest Like a Billionaire podcast, where we uncover the alternative investments and strategies that billionaires use to grow wealth. The tools and tactics you'll learn from this podcast will make you a better investor and help you build legacy wealth. Join us as we dive into the world of alternative investments, uncover strategies of the ultra wealthy, discuss economics, and interview successful investors. Welcome back to the Invest Like a Billionaire podcast. I'm your co-host, Ben Fraser, joined by Bob Fraser on another top of mind series. And so in this series, if you haven't listened to any of them before, these are really fun. These are kind of shorter little nuggets, and we kind of tackle, one or two things that are happening in the economy, just in the markets that we're in. And it's really kind of off the cuff conversation. So this is not scripted. We didn't, have really an agenda before this, but we had kind of a topic we want to talk about, and we think it's really relevant to today's investors. And just to kind of have a conversation about, what's going on in the economy. Are we headed to recession? What does that mean? How are these interest rates impacting, the world and the economy? And what is the Fed going to do going forward? And how do we kind of, make our positions as investors, with that information? So, I think before we kind of dive into some of these questions, one thing that I think would be helpful just to kind of break down for listeners that are maybe, not economists or newer to this kind of concept of, quantitative tightening, quantitative easing, raise interest rates, lower interest rates, and how that impacts the economy. Talk about, the Fed, their role and the economy and their mandates, and how interest rates are kind of related to those mandates.
The Fed's mandate is primarily employment, and to keep employment low and keep inflation in check. And, they've adopted various other mandates, kind of loose mandates from time to time, like, the stock market, and then not the stock market, but whatever. That's their mandate, is to kind of keep the economy from overheating. The one thing they have is short-term interest rates. So they actually control short-term interest rates. And by controlling short-term interest rates, it has an effect on long-term interest rates a little bit. It's more like grabbing the tail of a dog, and you can kind of steer the rest of the dog, but it's, the dog kind of got a mind of its own. And so that's the way long-term. So interest rates are 100% determined by auction at the market. So especially the longer term rates. So that's really what all the Fed does. And it's a pretty giant hammer. And that's the only tool they have, really. So they have this one tool. If you imagine you're a doctor, you go to a doctor, and the only thing they have is an amputation saw, right? That's their only tool. That's pretty much what it is with the Fed,
Yeah.
So it's a very broad tool.
Get the job done, but be a little bloody potentially.
Yes, and that's the only tool they have. Now, since the Great Recession, they've had another tool called quantitative easing, where they can actually go into the bond market and start buying bonds, printing money in essence, and buying debt. Well, they're not a market participant as a buyer or seller of that debt. And so they can actually affect long-term and longer term rates by actually entering the market. That's brand new. That's only since, 2009, they did that for the first time. And they go into the mortgage market, and they can go buy and sell those and control mortgage rates by simply buying and selling. So if they're buying mortgage rates are going to go down, and the Fed's balance sheet means the stuff they own goes up, it balloons. And that's exactly what happened. And then if they decide to want to sell that stuff, well, then interest rates will go up because there's now not only less buyers, but there's more sellers. And in order to be attractive, you got to sell it in higher interest rates. And so that's the bottom line. So what about inflation and interest rates? And they're not directly related, right? But it's kind of, you can think of inflation and interest rates as like two forces connected by a rubber band, right? So you can pull inflation a long ways over here, while one of the ways to cool inflation is to raise interest rates, right? And all of a sudden, that can create the pressure off inflation by reducing demand. If you put the economy in recession, you are going to slow down inflation because there's less energy use, less raises being given out. It's a very blunt instrument. So they're related, but not directly. But they're they push and pull each other, so to speak. So the primary thing that's going on right now, and it's very similar to what happened in the 70s, is we're seeing the Fed. The Fed is going to be very difficult to get inflation under control. One, there's so much liquidity created during COVID. So if you look, there's something like a $4 trillion in excess savings that people had because they didn't go out. So people's balance sheets just ballooned. Add to that, 3 trillion ish of stimulus will lead to put cash in people's pockets. So people were just flush, and the stock market going up and housing market going up, wealth effects. So you have all those things really made a very, very healthy consumer, and then add wage increases on top of that. So you're seeing, so it's going to be a lot to take the air out of that thing. And now, can they do it? Absolutely. I mean, they're working hard to do it, but it's a bit of an effort to take the wind out of that thing. So they're working hard on that. Can they bring inflation down? Well, here's the problem. Even if we went into full recession, it's going to be very difficult to take inflation down right now. And so there's a bunch of inflation components. But the big one right now is energy. Okay. And as I pointed out before, the problem with energy is the mother of all commodities, meaning everything takes energy.
Right.
So if energy's up, everything's up. It takes energy to ship your groceries. It takes energy to run your diesel tractors and your farm combine. It takes energy to run the mines, the mining equipment. It takes energy to commute. It takes energy is used in everything. And so if energy is high, then everything's high. And the problem is, as I've pointed out, is we have a pretty major energy crisis underway across the globe right now. And it's caused by this false narrative. And I went into this, in the 2015, that the age of fossil fuels was over. The world is massively underinvested in fossil fuels for the last 7 years. And so we have a production caps right now across the globe. And it's a huge problem. So the bottom line, so the Fed can create recession, but it's not going to cause energy to come way down. Now, can they cause energy demand to lessen? Yes, but it's still going to remain stubbornly high. And so the problem is, you can do that, but you're not going to get inflation down. So we end up in a potential scenario of stagflation, like we had in the 70s, where low growth, in and out of recession, but we still have inflation in spite of that. Kind of worst case scenario. So it seems like this might be what it's unfolding. And by the way, this is exactly the scenario that we were looking at earlier in the year, that we said this is the way it's going to play out. I said inflation is going to peak, but it's going to be stubbornly high. We're not in recession yet, but that's the way we're angling towards that. So it's kind of playing out really like we thought.
One of the goals of every investor and every trader out there is to try to read and predict what the Fed is going to do. And it's been so interesting to see kind of the evolution of the Fed's position on
We're laughing at that
visually,
joke,
right?
You sent out today.
Yeah, I sent a little meme I found, which I thought was hilarious.
Here it is.
Yeah, okay.
Q121. QE won't cause inflation. This is Powell. QE won't cause inflation. Then Q2, it's some inflation, but it's transitory. And then it's high inflation, but we're peaking. Then next, it's okay, inflation may not be transitory, but the job market wage growth is going to be very strong. And next, it's going to be, well, we need to hike aggressively to curb inflation, but no worries, the economy is very strong and soft landing is possible. And then finally, negative growth in Q1, but no recession risk. And then, okay, recession is coming. It's like, it just keeps getting worse.
Yeah, the line keeps moving on what they're tracking. To me, it feels partially planned, and then partially I think they are shocked in some ways and
Yeah. So
to
here's what happened. People attributed inflation to the supply chain problem of COVID.
right,
And it wasn't,
right,
but underneath was this sneaky inflation driven by energy that no one foresaw. So we have this massive energy shortage that's working through the system, and it wasn't exposed during the low demand years of COVID.
right,
And as soon as we exit from COVID, all of a sudden demand, all of a sudden it surfaces. The shortage just surfaces because there's not enough energy supply. And
right,
then shocks Ukraine, and now it's a holy smokes moment, like what's going on.
right.
And so it's this very sneaky, energy is what no one was counting on, and no one saw it coming, but it was very predictable.
Right. And so it seems like to your point earlier on, the Fed has this blunt use instrument that can work for certain things. And the idea of keeping interest rates high is it's going to slow down demand, slow down lending, going to slow down the economy,
Right.
hopefully to slow down inflation. But so much of what is driving the inflation numbers, the headline CPI, is energy.
This is solvable. The Biden administration is releasing from the Strategic Petroleum Reserve, which is really there to fuel our military in case we need it. So unfortunately, you know, it's it's really more of a political thing now. Let's get oil prices down prior to the election. That's what they're trying to do. But really, we need policy. They need to release oil and gas leases. They need to fast track energy infrastructure projects, including LNG projects, and that's what needs to happen. And even there, it's going to be very tough because those things take a long time to develop.
Right. Yeah. So based on kind of your interpretation of where the Fed stands, because during COVID, they were extremely dovish and they just opened up the floodgates to, make every effort to make it a soft landing. And they largely did, but maybe kind of kicked the can down the road a little bit. And now all of a sudden they've kind of turned and, channeled the inner Volcker, as we kind of joke, and are, kind of
Yeah,
shifting
I
more
didn't
to a
think they
hawkish
were
approach.
serious about it. I thought
Right. No.
Democratic administration, they're going to buckle, but hats off to them. They're not. He is Volcker from what I can tell, and I think everybody believes that right now.
Right. So
It's
how
very
much do you
serious.
think of this is posturing, right? Because we've talked about before because the Fed has such a large impact on kind of the expectation of the future and what it's going to be like. And so, sometimes they can posture whether, you know, positively or negatively, and it impacts the perception of investors. Do you think this really hawkish approach is more of a posturing approach to hopefully kind of slow down potential demand, or is it? I mean, it's anyone's guess at this point. But what do you
I
think
don't
would
think it's
go?
pure posturing. I think that's part of it. They do want to talk the game, so to get people out of the
Yeah,
inflation mindset, because inflation mindset creates inflation. So
right.
one of the solutions is to change the mindset. But I think they're very serious with it. They understand how damaging it is.
Do you see them holding interest rates high potentially throughout 2023?
I definitely do, and especially because my prediction is that energy is going to stay high, and so I think we're going to see prolonged period of higher rates. They can soften it. So it depends how deep a recession they want to create.
Right.
And
So talk a little bit about that, because that's kind of the big scary R word, recession, right? And there's obviously, that can mean different things as far as how deep a recession is, what markets and asset classes it impacts. I mean, talk a little bit about that as someone, who has not been through only really one recession, which was the Great Recession, 2008, but you've been through multiple. What do these cycles look like, right? What does it look like from a consumer and
yeah, I
investor
mean,
standpoint?
yeah, earnings drop and revs drop and OIs drop, and higher interest rates, which makes the cost of investment higher, right? And leverage, so which also hurts earnings. So it's things go down. Is it catastrophic? Rarely. I think the Great Recession was one of the worst we've had. I mean, really since the Great Depression, and so I don't think we should be looking for anything like that, especially since there's a lot of healthy foundation in the economy. So
Right.
this is actually a great time to buy. So when the market is just going up and to the right, right? Well, when do you want to buy? I'll tell you what's really perfect is when, as the market's getting ready to head up and to the right, it takes a little dip, right?
Yep.
And so that's is actually the time you want to buy. So given the trends we're following, so I'm following, right, this massive industrial trend, right? That is the reindustrialization, the reshoring of America, and the rebuilding of energy infrastructure, all those things. That's not changing in the next 20 years. Now, if there's a dip before that that lets us get in cheap, well, that's a gift, right? So we want to be able to move on those things. And so this is actually so counter trend moves are awesome buying opportunities. So that's my view. And there's a lot of things. So right now, energy is really top of my mind because this is just a huge opportunity, and energy plays are still massively undervalued. So,
Right.
I mean, Buffett is buying energy right now. What does that tell you? I mean, it's
As
the
a,
value.
the pinnacle value investor, if he's buying something.
Everyone hates it. You're pretty. I mean, if you're in energy, you're pretty much satanic. You're viewed as the evil of society because you're, create, you know, you know, using fossil fuels, which everyone knows is evil. And although everyone gets in their car, still flies, gets in that plane. Well, they do that. And you didn't use green energy to do that. So I love green energy, but green energy isn't there yet. And the bottom line is energy is still on sale and energy plays are still on sale. So pretty much I want to back up the truck in energy. We're definitely at Aspen are really looking at more energy plays, really, really smart energy plays. And there's looks to be some killer opportunities still. Surprisingly, the world hasn't woken up to these yet. Great, And the other thing is inflation is the friend of real estate, right? They're very good pals.
Mhm.
And so if we see NOIs drop and we see deals falling out, which we're seeing a lot of like Class C multifamily and stuff falling out because all of a sudden the rehab costs went up because of inflation. These deals, they didn't fund them enough to do the rehab, the value add piece.
Right.
Right. And they're falling out. And so we're seeing those dropping in price. Great. Time to
And a
pick up.
lot of the really aggressive bridge lenders, which we've been talking about for a
Right.
while, is
We've been talking about that as the huge risk is the bridge lenders.
they've completely left the market, or at least get not competitive to where these deals start penciling. Which
And so that's causing deals to fall out and prices to soften, which now maybe we have not been doing a lot of multifamily recently. And, in the last part of the year. And, because of that. So now it looks like hopefully we'll start to find some deals we like again.
Yep.
And so it's all good. And we got a multifamily coming up that we're super pumped on, but it has a 3.5% consumable Fannie Mae loan on it. It's like,
Right.
and it's Class A. So it's still a killer sweet deal. So there are a few sweet deals, and even there, remember inflation is our friend. So even if there is a little recession, okay, how long is it going to be? 10-year recession? Those things, it's just unheard of. Recessions last, usually not the Obama recession was a different, he managed to make it last a good 6 years. It's super skill of a guy who had no business experience whatsoever. In fact, no experience whatsoever, but making speeches. So, but that's most recessions are short. So even if that happens, you have some NOIs hit. As long as you can cover your cash flow, cover your debt service, you're good. So you want to make sure your investments are super solid, and then you just write it out and extend your, if your timeline was 3 years, we make it 5.
Yep.
And you're fine, right? And inflation still is going to be your best friend as long as you don't get shaken out of the deal.
Yeah. Awesome. Well, hopefully this is some helpful kind of thoughts as we're all, trying to find opportunities and position ourselves as investors in good ways, kind of for what's going to come in the rest of this year and the next year. And I don't know if you have seen recently, if you've been following this podcast, but we just launched our new website at thebillionairepodcast.com. And on there, we have several things you can do. It's easy to follow along all the episodes. But we also have this new thing you can click on there where it's basically says ask anything. And you can really ask questions you're thinking about, right? And so this is,
What do you want to know?
what do you want to know? So we want to do a lot more of these types of just kind of short, one hitter, a little podcast top of mind. And we really want a lot that to be driven by listeners' questions. And so if you have
Definitely.
questions, things you're thinking about, we would love to see those. So please go in there, submit your questions. You can do a little voice text, and it goes straight to our team. And we'll review those and listen to them, and maybe we'll even feature your question on a future podcast. So please go there, check it out. Hope this is instructive and valuable, and tune in next time. Thanks so much.